So yeah, as you said, an intimate setting. So I don't know if I should sit down, but maybe I'll follow along with you and stand up. So it's great to be here. I have to say, you said a long distance. Typically, most of your faces I've seen in the distance between me and my laptop screen. So it's really nice to be out here and particularly having a conversation in this topic or this topic that is important to us. Also to introduce myself. So on behalf of the African Development Bank, where I work, and my director at Sukotoda, who would like to be here. She's a director of agricultural finance and rural development at the African Development Bank. For us, this is a particularly important conversation, and we are glad to see a lot of increasing interest in this. And this is particularly at the bank. There's been a renewed effort to think about how to systematically provide support to financing of Agri-SMEs. Because as a large, AAA rated multilateral development bank, Agri-SMEs are not our typical bread and butter. But as we are committed to the agricultural transformation for a whole range of the development impacts that are our mandate, there's no way we can look further than Agri-SMEs. So about 2 years ago, the bank set up a specific program on Agri-SME development and innovative financing, and I am the lead for Agri-SME development innovative financing. So started with one person, but the program is rapidly building. And building also because of the partnerships here. So thanks to SAFIN also for inviting us here. The SAFIN and its network of partners has been very critical, as explained to us, also thinking about what is fundamental to ensuring we unlock finance for Agri-SMEs. So we're supposed to talk about finance for Agri-SMEs in the times of crisis. Right? And when you think about financing and SMEs, a crisis, you look at crisis from a lens of risk, right? And so you wonder, is there ever a time that Agri-SMEs don't face some risk? Particular Agri-SMEs in Africa. So when, right now we have the newest threat. It's a big threat, of course, rising prices, fuel, commodities, and inputs for, as a result of Ukraine. But, if you think about, the context of the African agricultural system. It's a system that understands risk and has grown to be resilient with risk. Because if it's not Ukraine, it's COVID, and the long protracted impacts of COVID. And if not that, it's locust invasions, or it's fall armyworm, or it's fake seed, or it's you name it. And despite this, there's still some resilience in the system. You still look around and you'll see, farmers are still producing. Livestock herders, boom and bust. They're still out there producing. And of course, across the entrepreneurial value chain, if it's the mama mboga or the vegetable lady and selling vegetable in informal markets, or it's the cooperatives that are aggregating dairy products to sell, or it's the fisherman who is selling his fish. They all understand risk from the point of view of the difficulty for them to access resources to grow, for the mama mboga to be able to get more produce, to be able to expand her revenue base, or the cooperative to be able to get a loan for a mini processor to upgrade to a yogurt, or a fisherman to get a mobile cold storage so that they can expand further afield and again increase their revenue base. So, despite this crisis that beset us, I think for us in this space, despite the systematic presence of risk, we should begin to recognize and maybe change the narrative toward the resilience that is there. Lest we pay the price for always being reactive and allowing the perception of risk or any new crisis have us now start rethinking what we need to do. Because we're in the business of risk and of providing a set of innovations. Ayodeji was talking about, what is the kind of capital that we need? How do we de-risk this? So colleagues, these are the things that I think we would want to ensure as we're trying to think through what are the what are the set of opportunities? What are the solutions that we need to put in place? Excuse me. We need to take a step back, and I think this is what this conversation is going to be about. And let me just I recall one of the challenges we face. So I'm telling you, we are putting together this new program. And just recently, we were working in the bank, African Development Bank, with a set of colleagues who are putting together a very interesting operation for an impact fund that has identified a whole pipeline of very bankable Agri-SMEs that were aligned with some gender financing principles and so on. They put together a package that also had de-risking mechanisms, first loss, and sub-debt and so on. But despite a well-packaged proposition that they have cooked for quite some time, they came to the Credit Risk Committee, and the Credit Risk Committee looked at it and said, I know you have guarantees here, I know you have sub-debt, but we think the risk is still too high, right? And so this narrative of risk, as we keep calling it, I think we should change the way we frame it, so that the products and the actions that we're putting in place to de-risk can be recognized by those gatekeepers of credit, and at the same time, unlock or minimize this sometimes unfortunate perception of risk that goes beyond any real risk that is in the system, right? So, against this, if we step back and we look at this backdrop of concern of global recession, against this, the world is still awash with historical levels of credit. Several trillions of dollars that are sitting in, central banks, in bonds, earning 1 to 3% interest rates, very low interest rates. They're looking for opportunity. This is why you hear right now the biggest concerns in, the U.S. Central Bank, the Fed, and others is inflation, because of the historic low returns that all this credit is getting. So just imagine if we could figure out how to unlock just a slice of those trillions, right? To unlock them for what are the latest estimates? About 130,000 Agri-SMEs across the continent who are facing, say, about a deficit of 100 billion of financing annually, right? How do we convince those creditors who are willing to lock money down for a paltry 1 to 3%, that actually the returns here are quite good, or can be quite good? And you see, there are green shoots of progress. And if you look around you, I don't know if recently just last week, McKinsey produced a report. I think the report was called, sorry, this is not working so well for me. Who here has read that report? It was called the FinTech in Africa, the end of the beginning, right? And what they highlighted is that just between 2020 and 2021, right, when we're going through the backdrop of the risks of COVID and supply chain problems and so on, right, the FinTech investments in FinTech in Africa tripled to 5,200 of them, 5,200, all receiving equity and capital from private investors. So despite that backdrop of risk, there's a lot of interest. Why is there this interest? And then if you look at these fintechs, how are they positioning themselves? The largest sector of these fintechs is retail and SME financing, right? So they're learning, they're putting together a series of technology to be able to go directly to this otherwise risky SMEs. What's the second biggest subsector? Insurance, right? And a lot of this is also insurance for agriculture. So there's something that they know that we should be able to also help to leverage and accelerate. And how do we do that? Right? So I think just within this room, if we think about what are the key principles then, it's not that we have to start afresh, as I said, every time there's a new crisis, right? Just within this group, if I look back a bit, I met several of you. I imagine quite a lot of you were involved in the process of the UN Food System Summit, right? toward the end of 2020, 2021. And I remember working with SAFIN and its other networks of partners, AGRA and GAIN, to serve as champions for Agri-SME financing and innovation at the summit, right? And they had these process of game changers, which were very elaborate collaborative processes that were vetted by, myriad experts and practitioners. And from the point of view of the game changer that we led it, which was the game changer on establishing catalytic SME facility financing, there were three key core pillars that came about, right? And these pillars, they have withstood the state of time. The first is the requirement of concessionary capital, right? So this is, highly concessional, risk-taking capital that can really facilitate this de-risking of intermediaries to mobilize capital flows, right? And blended financing becomes key here. And this is one of the key frameworks that we begin to understand. How do we pull public sector resources that are otherwise going to, the billions going to agricultural subsidies that we know are not really as impactful as possible? How do we draw this public finance to further catalyze private sector and co-opt them to support the development impact requirements that we are seeking from, for example, the Agri-Food system? So first is accessing this concessionary capital and blending it appropriately. The second pillar is technical assistance, right? So technical assistance is required to ensure that, first of all, we increase the critical mass of these SMEs that are out there, ensure that they are bankable and that they can provide the signal of bankability that is required by the capital providers, right? And now this signal, the signal that is required is the third pillar. And the third pillar is really an impact mainstream. And why do I say impact mainstreaming? Again, back to the whole framework of blended finance, right? The only way you can pull capital to support the private sector, pull public capital to support the private sector, is if the private sector, in pushing for its for commercial viability, is likewise also making progress on a range of development impact concerns, right? So this is how you'll get this concessionary capital. This is how you'll get the grants for TA from the public sector. But you have to have mechanisms that can cheaply and credibly signal or certify the impact credentials of these Agri-SMEs, right? So once you're able to do that sufficiently cheaply enough that you can support with the TA Agri-SMEs to signal this, you get the financial intermediaries and capital providers to show donors and public sector governments that they're actually directing these resources to Agri-SMEs that are providing jobs for youth and for women, that are providing food that is healthy, that are providing it in a green and sustainable manner. Then you'll start to see, we believe, the resources flow. And so if I could just, put a quick plug here, because certainly there's some nuances to these three principles. And you'll see different models. And later on, Aseli that has really, perfected a subclass of model under this blended finance will be giving some lessons. But if for us at the bank, these three pillars, working together with SAFIN, AGRA, and other partners in this game changer process, we were able to take these three, the lessons and the ideation we got from this process to put together and design our own, what we call the Agri-Food SME Catalytic Financing Mechanism. So this is the ACFM. It's a special fund that has been launched by the African Development Bank just earlier this year. It's $100 million, 100 million Canadian dollar special fund. And if I could just very quickly, because we're here open for business, so let me just tell you, according to those three principles, what the ACFM does. So in terms of concessionary capital, so the ACFM, the special fund provides concessionary debt and concessionary subordinated debt. 35% of the capital can be provided in this higher risk tolerant form of subordinated debt. The recipients or the investees are these capital intermediaries, so impact funds, commercial banks, and agribusinesses that aggregate producers. All right, so In terms of the second pillar, technical assistance, 20% of the total, of the capital of the total fund is directed to TA. And TA can take several forms. It can be integrated with a loan to a capital provider to help them improve the systems that that help them identify SMEs that are impact oriented. It can be directed to enterprise support organizations or business development service providers that are likewise, building this impact bankability into Agri-SMEs and so on. And then finally, of course, impact mainstreaming. These funds are able to be concessional. These grants within the funds are able to provide TA because of a focus on gender financing and climate. So any recipient will need to demonstrate their gender and climate credentials. So that's that. But ACFM, our fund is not the only one out there. There are many out there. And even as we are banging on the financing gap, there is still a question about how fast can we deploy these funds. There are lessons out there of funds that have come out, that have launched, and for several years have not been able to identify deals to deploy. So what is the challenge there? And I think that is something that as I finalize and open up to our colleagues from ASELI, I want to remind you of the challenge that our investment officers faced. As I told you, they went up to the credit risk committees, right? These are issues of policy and regulatory constraint within the gatekeepers of credit in our institutions, whether it's in the banks, central banks, and so on. And so unless and until a set of regulations that do not credit the de-risking properties of these instruments that we are trying to provide, we're not going to unleash the full power of credit. So this study ASELI did, looking forward to hearing it from Etienne, just highlighting some of these constraints that can be locked, and that we at the bank would like to partner with you, even discuss actively through this week on how we are really going to make these crises. They talked about in COVID the build back better, right? And that the silver lining of crisis, which I hear also AFEX, during the time of COVID, some of the silver lining shined on your operations as you increased revenue and expanded from Nigeria, I think, to Kenya and Uganda as well. So within this crisis and the insights that we get to understand and we'll be discussing, I really also want to throw a challenge that we take advantage of being here together, just the beginning of this AGRF, one of the most critical annual forums for agricultural stakeholders who are keen on transforming. And let's see how we can actually put together coalitions to continue to actually address some of the challenges that have been highlighted and unlock the financing for Agri-SMEs. Thank you very much. I think should I pass it back to you to open or? Yeah. All right. Well, thanks a lot.
Thank you very much. Thank you. Welcome our additional guests. We're here to find solutions at the heart of Agri-SME financing. And when we started, we said we want to work out with 3 items that are potentially actionable, and providers of capital can start to tweak their model, write check against, or get things through. So the conversation is going to get into we just had a great keynote from Andrew, and we're going to get into a presentation from ASELI by Etienne. And after that, we're going to have a conversation across this topic and try to see what our views, what our experience, what anecdotes, and how can we start to reframe, the lenses at which you look at this problem. Thank you very much.
Thank you very much, Deji. So allow me just to leverage technology and use some. So it already has its limitations here, so we're stuck here. Just want to leverage technology and share some visuals to help me explain what I see as complex concepts easily. So first one is, of course, when I'm asked to speak about financing Agri-SMEs in times of crisis, the first thing that comes to my mind is, well, agri-finance has always been in a crisis. So that should be very easy for me to talk about. And of course, Andrew, thank you for making the transition to this particular conversation. Obviously, I have one question for you. We can discuss much after this. That is me seeing an SME talking to ADB. It has always been quite a puzzle. So hopefully there are people in the room who also have similar questions. So there'll be an opportunity for that. But let me start with a quick intro. My name is Etienne Ndatimana. I'm the head of operations at ASERI Africa. I'm glad to see I have a colleague here, Belize, at the corner. She's based here in Kigali. So if it is, you need to talk to ASERI in Rwanda, definitely that's your person. And I also recognize, several partners that work with us in the room. So hopefully we'll have time to chat more with them. ASERI Africa is a development organization with a mission to unlock financing for agricultural SMEs. Now here is, all right, thank you. So from the onset, we sought to actually understand why there is little financing going to the sector, yet this particular sector actually creates more employment in emerging economies. It contributes significantly to the GDP of the economies, but yet there is very little going on there in terms of financing. These numbers here, you can see in East Africa, 2/3 of the workforce actually engage in agriculture. Yet, only 5% of the commercial bank financing flows into that particular sector. That's really a huge gap. So we were curious now to understand the details. Why is there little lending happening in the ag space? So one finding after looking at the data from agricultural lenders, now we have looked at over 20,000 loan transactions from close to 40 lending institutions and covered billions worth of financing for agri-SMEs in dollar terms. Here are the critical key findings. One is we confirm the hypothesis. Yes, lending to agriculture is very risky, but how risky is it? So we were able to quantify this. It's twice riskier as lending in any other sector for the same lender. So here we are looking at the loan write-offs. For example, across banks, generally looking at their entire loan book, in general, in East Africa, it's about 1.7% losses across. But if you look at the ag portfolio, it's around 3 to 3.5. So that's really double. We even went ahead and compared what's happening in Africa versus what's happening in Latin America. So in Africa, the risk is double what is in Latin America. Maybe those are many details. But what happens is not only lending to ag is risky, but it's also costly. Because obviously you have to travel miles, go to the rural area to look at a potential deal. And the higher risk and the cost when combined actually now lead to lower returns when you lend to that sector vis-a-vis other opportunities available. So for lenders, there is an opportunity cost. And that's why you see them moving away from agriculture, because definitely the risk is higher, the returns are lower. I think if you're rational, the decision to make. For us, we're interested in agricultural SMEs. Why? Because that's where there is even much less lending happening, yet these are businesses that are actually serving well the rural economies. We have agricultural SMEs aggregating, the harvest from smallholder farmers, processing that, and getting it marketed, to the end buyers. They sell input, seeds, fertilizers to the smallholder farmers, and they contribute to food security and nutrition in the rural places. Some of the produce comes from their own processing, other produce comes from the big guys, but the guys who do the last mile distribution. So that's the segment you are interested in. For us to do this, we mobilize donor funding. So we are donor funded. And we use the money from donors to pay financial incentives for capital providers or lending institutions and into agriculture. You can see the list of our donor partners. We also fund technical assistance going to support SMEs or lenders to kind of capacitate them in lending well to the agricultural sector, which is quite novel, which is new to them. They are used to the traditional lending to where it's easy to make money. So agriculture is special. Over time, and as we do all these, we collect a lot of data, and we share the findings and learning to the public. Of course, that's free of charge. It's donor funded. In the next 3 or 4 years, we hope to unlock at least $600 million USD in lending only in East Africa. And we plan also to expand beyond East Africa. But that's the targets for East Africa. And this lending is, we estimate that it's going to help over 1 million smallholder farmers to improve their livelihoods. But more importantly, we want to demonstrate that this is viable and have our model replicated and done by many other people, because the challenge at hand is huge. We cannot do it alone. So perhaps the most interesting concepts in what you do is the financial incentives. TA is known, data and publications, all those things are easy. But financial incentives for Aseri Africa are twofold. So one is what we call a portfolio first loss cover. For a qualifying loan, so there is a loan range, the characteristics of a borrower who qualifies. If a lender has given a loan and reports that to us, then they earn a certain amount of money. It's a percentage of the loan value, and we put that in the reserve account. And of course, the more loans they do, the more they accumulate. And in case of any losses in that portfolio, then they can make a claim and they will be paid. That will reduce their losses from lending to the Agri-SMEs. And the amount, as you see, ranges from 2 to 9%. We run all these in USD. So if you lend in Rwanda francs, we convert that into USD and you keep the money in USD until such a time there is a loss. For origination incentives, which is meant to help lenders meet their costs of sourcing for deals, monitoring for the investments and evaluating all that, we directly pay. As long as that particular loan qualifies, we pay. So they can use the money to probably hire more staff to source for deals, or do more visits, or improve their own systems and processes to lend more to the agriculture. So these can be as low as $2 or as high as $16,000. So unlike the first loss cover incentives, for the origination incentives, we use a smooth curve. So it doesn't go up with the size of the loan. Actually, the smaller loans earn more in percentage terms because that's where we want to encourage lenders to focus. So the bigger the loan, the less you get as incentive because it gets closer to the profitability level. But this is really what we are up to. So for now, as I said, ag is in crisis. I think we all agreed. So it's not profitable and there's little going there, and lenders are very choosy. They select which deals are likely to make the bet. Let's do it the minute you take on a loan. So meaning you're already taking your scarce capital, put it aside, so you can meet those losses in the future. What does that mean? If agriculture is very risky, Then instead of taking my $2 to cushion against this, to put them aside, I rather lend, say, for mortgage where maybe it's less risky, and I put in $1. It's very simple. So that's really the problem. But there is also one thing, if we want to really proceed, you remember I began that agriculture is very important because of the contribution to the economy and so on and so forth. Then let's meet that particular challenge with some investments that are meant to capture the impact of agriculture and all those other important sectors. So I think that's where actually a selling model falls, because we're using donor money to actually provide incentives. So lenders can actually have appetite to lend to agriculture. We think over time, governments, if interested, can actually take these over. As subsidies, especially ag, are there, I don't think there is any secret about it. In the developed world, it's done. So why not in developing countries where probably the impact is much greater? The other challenge is around the capital adequacy ratio. So this one is actually, when combined with IFRS 9, then they definitely lenders will move away from agriculture. This one is looking at risk, asset risk weighted assets. So looking at the entire portfolio and saying, okay, the central bank has set, a minimum of capital that, an institution ought to have to stay in business. And that particular capital, if then is entered into by lending to agriculture, which we say is actually riskier, and by that you allocate more capital for that, that means definitely agriculture is the least priority for the lenders. Maybe before I get to the case in point where they have tried to resolve it, let me speak to the loan classification. Again, a deal or a loan, say in real estate or housing, and a deal in agriculture, we always have some differences. When you're looking at, let's say, delays in payments, and then you have to provision for X percentage that goes to the loss provisions. For example, you are a civil servant or an employee earning a salary, you borrow to buy a house. If you delay to pay, somehow, somewhere, I think things are starting to go wrong. But for agriculture, sometimes you may delay to pay simply because you could not harvest today. You will harvest next week. Or transport, logistics were a problem to get them across. So, but because you have just crossed the 90-day classification, then you provision for more, but in actual sense, not like the underlying asset has lost value or is weak. It's just what's peculiar, what's specific to the agriculture. So we feel like if agriculture is treated like any other sector, those problems will always arise. Collateral requirements. This is, I think, the easiest in terms of dealing with. Agriculture happens in rural areas. And if you have a piece of land in the city, in Kigali, and a piece of land somewhere in west, south, or east of the country, same size, obviously the rural piece is probably worth a quarter of the value of land in the capital. Yet that's the land you use as collateral for borrowing. So meaning the value is very low, so you can only borrow so much. That land value is going to allow you. So that's also an impediment to investing more in the agriculture. So the more the collateral is required, the more problems we receive for the agriculture. Credit guarantees, especially when they are not funded, they are also not even considered to meet the capital adequacy ratio requirements. So again, meaning there is less available to lend to the agriculture. So here, I wanted to just share two examples of where elsewhere they have tried to resolve a few of these regulatory issues. Like in India, they have set a minimum for every commercial bank, at least you lend 18% to the agriculture. That's a minimum. If you are not able to, then there is a penalty. You contribute some amount to a reserve somewhere that another bank can take and use for agriculture. So in the end, it's to benefit the agriculture. If you don't want to do ag, fine, put money there, we'll use it, avail it to another institution which can do it. In Uganda, just across the border, they have what they call the agricultural credit facility, which in essence provides capital for meeting half of the loan value at 0%, which the government requires the lender to pass on to the borrower. So it works both ways. It encourages lending to the sector, but also at affordable rates for the borrowers. But we are not prescribing, we're just sharing examples. And we think a combination of all these solutions in one particular jurisdiction may work best than just picking one single solution. So I will stop there. Andrew, Deji, back to you. I think we can discuss some of these things in details. They are interesting, and I can stand here speaking the whole afternoon. So back to you. Thank you very much.
Hi everyone. Great to see that we have more people in the room. Thanks everyone for coming. Andrew, thank you so much for the keynote. Etienne for that great presentation. I'm actually going to, I think, attempt speaking without the microphone. I was brought up American, so I was brought up to project. Does that work? Or no, you need the microphone? For recording? Okay. All right, no worries. Essentially, I represent SAFIN, so I'm the technical specialist for the SAFIN network, or the SAFIN secretariat. We're housed under IFAD, which basically serves as an incubator, but we operate as a network. And what that means is that we bring together a large number, well, not that large actually. We're about 53 institutions now, and growing, I would say. We really work on, I think, the quality of the types of institutions that we bring into the network over the quantity, mainly because we are very focused and the only network focused specifically on Agri-SME finance. So that's kind of a small world, as it were. And what we're trying to do is to bring really a broad spectrum of different types of organizations and people who work in that sector to represent basically all of the different facets of Agri-SME finance. So our partners range from public sector institutions, DFIs, development institutions, through think tanks, philanthropic institutions, advisory institutions, consultancies, down to, through private sector, so finance institutions, impact investors, alliances of financial actors on the ground, and then also bringing in Agri-SMEs such as AFEX, and other actors that group up sort of cooperatives of farmers, for instance, which we include also in the Agri-SME, or sort of missing middle segment. So we have a number of partners here, African Development Bank, obviously ASELI, AFEX, and IFAD, of course, and if I'm missing anyone else who might be in the room here, please let me know. It's good to know that we have some partners. So in that view, trying to understand what we try to do with our partners is try to understand essentially across three main pillars, what is motivating Agri-SME finance. So there's a big part of it which is obviously around knowledge exchange and development, trying to share the learnings from our partners, and trying to basically sort of bridge the gaps. And I think that that's kind of what we would like to do here today, which is try to understand, from other participants here in the room, experts, people who actually work in the field, what do you know? What can you contribute to the conversation around, a lot of what we just discussed here and what was presented by both Andrew and Etienne. So we basically wanted to make this more of a conversation. So we really, welcome you all to make your voices heard, share your experiences, share your knowledge, your opinions, so that we can try to sort of tease out some of the key pieces of knowledge that we might be missing or overlooking. And if we can go to the list of questions. We'll just put those up. So we've developed just some questions that are quite general, and we've got about, I'd say, 40 minutes. We might be going a little bit over time. Hopefully that works for most of you. You can stick around. And we'd like to go into some level of detail on some of these questions. And we'd also like to build on what was just presented by both Andrew and Etienne. And that means that in both their cases, they've essentially identified, what they and their experience and their organizations see as some of the key challenges to Agri-SMEs, and what their responses have been. And we'd like to basically turn to you and see whether, out of your own experience, are there any of the key challenges that are being overlooked? Are there key lessons learned that should be considered? Are there, elements of Agri-SME finance that demand more attention as we look forward to sort of, developing new models or scaling or replicating existing models? And so what I would propose to do, because we have two speakers, as it were, that were originally slated to speak as a panel. So Ayodeji Balogun, who's already presented himself, Nadine Bosa, who represents IFAD and the Food Systems Coordination Hub. And so maybe I can just start with both of you. Nadine, again, building on what we just heard, in your view, are there any sort of key elements around the challenges to Agri-SME finance, or key learnings that haven't already been covered and that you think need to be addressed?
Well, thank you for giving me the floor.
Do you want the... Yeah.
Yes, thank you for giving me the floor, and I think the presentation is so... No?
It's gone.
It's gone.
Is there a technician or another microphone? There you go.
Yes, Thank you very much. And I think the presentation we saw were quite exhaustive. I actually have a comment on the second presentation where you actually mentioned that the level of risk in agriculture were much higher, and that's also the reason why the level of finance is lower. We have been arguing a lot that, yes, while the level of risk is higher, I mean, the level of repayment is also sometimes higher, and you also have different factors which are kind of reducing the risk. We were, for example, managing financing a project of IFAD in Nigeria, and we saw that when you were actually putting the value chain actors together, you had a significant way of reducing risk. Let me give you an example. We had a financial institution very enthusiastic about providing loans to smallholders and SMEs, for the reason that you had different actors involved. You had, for example, IFAD providing technical assistance to the farmers in terms of training, in terms of also inputs, subsidizing part of the input in terms of support for land management. We were also working with local government, which were providing investment in the sense of water storage, or in terms of access roads. So what you see is that when you put actually the different actors of the value chains working together, the local governments, and supported by the donors, and we also had off-takers, which were interested in providing some of the financing at the beginning of the farming season. You had a very established opportunity to lower the risk. And in the different models initiative you have presented here, I haven't seen that kind of experience, but we really got the feedback that we were also working on the same thing in Kenya with Equity Bank, where they felt that it was profitable actually to extend financing to this target group, because the level of risk was extremely lower because different actors were involved, and then they felt that this is a group where the risk is going to be limited. And so I wanted to see how you reflect that in the lesson learned, that really the value chain approach driven by the market, where the government, the off-takers, the technical service, extension service, I would say, work together to provide the right kind of support to the SMEs. You have the opportunity to lower the risk and attract other financial institutions. So in a way, I'm sharing a bit of a learning that I didn't see reflected here, and whether you also consider that this is the right way to lower risk. Thank you.
Thank you for that. Etienne, do you want to answer?
Sure.
Just before I give you the microphone, I want to let everyone know that there's coffee outside if you need a little caffeine jolt to stay awake.
Yeah, thanks for your I think contribution. I didn't think it's much of a question per se, but a contribution, sharing examples of situations that have worked. So here is probably my quick 1-2 words of feedback to this. Basically, any rational lender will assess the risk in lending or investing in a deal, whether it's ag or non-ag. But there are certain things, obviously, that must be in place. There is, the profile or the credibility of the borrower or investee, which sometimes comes to character. Even when things actually work in business, character could be a challenge. But in ag, particularly, access to markets. So I give you money to invest in equipment or to buy working capital, but do you have a guaranteed, market so you can use the proceeds to repay the loan? Then on the other side, before you even get to the market, or how you serve the market, do you have access to enough raw material to be able to guarantee output that's required in the market? So those are the fundamentals of lending. And if they are met, that's well and good. Now, the challenge comes when you see a lender who's seeing two deals side by side, one in ag, one outside ag. And they are looking at the potential returns. That's now the risk of default, probability of default. You're saying, okay, well, here I may, get 2% return. This other one, fine, I invest the same amount of money, but I get 0.5%. And that's where the problem really comes in. And for the many reasons we have listed. So we are not saying agricultural lending isn't happening, but it's not happening to the level we want. And yet we know that's where the greatest impact possibly is, together with other social sectors, health, education, and so on and so forth. So I agree, in terms of trying to manage the risk at sector level, those interventions that support SMEs access to either input or raw materials or access to markets are definitely helpful. But the other systemic problems that must be addressed, and that's where issues of subsidies and the other interventions are coming in because of the economics and dynamics of lending to agriculture versus other sectors.
Thanks for that. So one thing that comes to mind in this discussion, and obviously being SAFIN, working at IFAD, is the question about these collaborations and the importance of partnerships, which I think is clearly a big one. The question, I think, is also, does it lead to the level of scalability and replication that we need to actually address the size of the issue, which eventually needs to be addressed locally at the commercial level. So getting the right incentives in place and everything is supposed to launch or kickstart things to get to that level. And I want to turn to you, Ayodeji, and ask you, as a private sector actor, where have you seen success in sort of, whether it's models or anything around those collaborations that have served either you or others around you that you're aware of in terms of access to finance?
Okay, thanks, Mark. When it comes to access to finance, it's always easier to talk about the things that don't work because there's a list of like 14. But so one of the things, two things that come very strongly to mind on this, right? So the first is that the talents in the room, the quality of the talents in the room, every time you discuss agriculture today, is way, way better than we've ever had it, over the last 4 or 5 decades, right? So I remember when I started agriculture, sort of like 2010, 2012, you'll go into the room, I'll go into the room to a meeting as an analyst, and everybody in the room will be, 55 going to 60. And the conversations were not as smart, and so the quality of talent in the sector is improved dramatically. So one bet I always have is that it doesn't matter how hard the problem is. If you have the right brains in the room, you will solve for it eventually. So that's one of the things I think generally is getting things forward. We hope we keep the talent in the room and not, get out over time, but that's one strain. The second is that technology, right? So the wider application of fintechs, and then the adaptation of that into agriculture is bringing newer models. So you see this from the point of how can you then bring in new structures that are sort of aggregating, smallholder farmers, because the big challenge around lending to particularly production in agriculture is producers, smallholder farmers, and then the intermediaries that serve them, agro dealers, Agri-SMEs, is that whole transaction cost. right? What's the cost of finding a good deal? What's the cost of managing, underwriting a good deal? And then what's the risk of repayment? So you're seeing newer technology-based models that are aggregating deals on that side, that are taking 1,000, 10,000 farmers into 2, 3, 4 transactions. So it's making it closer and bringing more data and visibility into that sort of very fragmented, very pluralized space. And that's sort of making, a lot of them have failed, some of them have worked very well. In Nigeria, we had a spree of crowdfunding, and it was sort of like pushed as a very strong model, but it's just too impatient capital, and expensive capital to solve the problem. But it's innovated, people have morphed and evolved into other models. Commodities exchanges are one of the very hard, sort of like, 400-pound gorilla in the room. How can you make a commodities exchange work, and what problem should it be solving? And does it need to play that role of aggregation and disintermediation of capital? So how can we nudge those things? I think generally between newer business models, tech-enabled business models, and then higher quality talents in the room, those are some of the genres of progress I've seen.
Excellent. Thanks a lot for that, Ayodeji. I want to turn to everyone else in the room here and see whether anyone else wants to contribute any thoughts on this. We'll get a microphone right to you.
Laurie Jala is my name. I'm from Nigeria. And Andrew, well said. Each time we talk about risk, and you talk about the amount of money that we had that wasn't going anywhere, going under 1%. The question I have is, whose perception of risk? When do we need to begin to talk together and see that the way we are perceived, especially Africa, all of us, the perception of risk is not real. I see a lot of money go to other climes, and if you check their perception of risk, it should be worse than where we are. And the return here is huge. So I think we need to begin to seize the narrative. Otherwise, this money won't come here. I don't want to mention a number of states in Europe. If you look at the state of their finances and co, they should be a lot much more challenging than us. So until we begin to seize the narrative and begin to ask the question, whose perception of risk? Because, I've been around for quite a while. First to say, well, our system of government isn't good, rule democracy, do all those things. People have changed and begun to do all of those things. But yet, I haven't seen that perception of risk changed. So I think maybe one of the things we need to do through coalition is to begin to ask ourselves, whose perception? Is it real? Thank you.
Thank you.
Okay, me, I'm Mr. Salia Amaria Yusufu from Burkina Faso. My English is not, but I want to address one key problem is market access to market. Food security is a big market for the enterprise we are talking about. If they have money and then they can't go to the market, is a very, very big problem for all enterprise on access to market. The first thing is not probably finance. The first thing is how to access to market. If you go to bank, the first thing they're looking is how you will work to reimburse the money. IFAD is here. Food security in Africa is a very big market for us. But the problem, how to access to this food security market. We have to address this. If we address this problem, we resolve the problem of risk.
Way.
I can say, I mean, I was IFAD country director in Nigeria, but I was also privileged to be the director for the whole region, covering the 24 countries. And it's true that access to finance is I can see, a key part or a key ingredient in the support we have provided to the SMEs. I would say two things. First of all, reacting to the question of risk and whose perception of risk is it. I'm not a financial institution, but I think the issue of risk is more than a perception, but it's really felt as a reality when we do have smallholders or SMEs which are essentially relying on rent-fed agriculture. And we know, I'm just giving an example, and we know what the situation is in our country in terms of rain and in terms of a situation that you can see that basically the whole production is lost because it hasn't rained or because it has rained too much. And there's absolutely no control in that, and indeed there's no investment, I mean, whether it's public investment or private investment into irrigated agriculture. You also have the issue beyond the rain. You still look at me smiling, but it can be, well, it's an opportunity, but actually we see just production being washed away just because it has rained or not rained, or because, I mean, you have so many issues coming in. We also have a big issue of the quality of the inputs, the quality of the seeds, and you see again that farmers are planting and then what is coming out of it, because we still don't have the right institution for certification or the right quality of input. So yes, I mean, you put yourself in the shoes of the financial institution. I don't support them, but it's actually a more risky business, and I think it's not a perception, it's a reality. And what I was explaining before, to respond also to your question, is that what are the kind of models that are being put in place to reduce this risk, at the risk of not saying that they don't exist, they are real. And what I was mentioning as a model is when you put in place a system, when I was telling you that, I mean, it's one of the most beautiful projects I had seen. It was in Nigeria, it was this rice project, because you know Nigeria has 200 million people, so they have, I think somebody mentioned, they have a huge market. So you basically have a lot of agro-dealers coming to Nigeria because they want to buy the rice and they want to supply the market in rice, and they need somebody to produce that rice. It's a combination of factors. You must put in place the right tools. The number one is that you must have a market. And I'm sorry to say that the government put in place policies, and you know it very well. They closed the borders. So there was a market. You needed to have the rice produced locally, and so basically, suddenly you had a huge market being created because they were not authorized to import the rice. So the number one to reduce the risk is to secure the market by the institution and the policies. The second element we had is that you had, I mean, you would sell, and so the financial institution were inclined to loan to the farmers to produce, because again, conditions were put in place, and here local governments have to play their role. They agreed to invest in agriculture in terms of irrigation, in terms of our brother from Burkina Faso mentioned it. They were also doing the local planning and doing the access road to the market, so you knew that they were playing their roles and that there would be an access to the market. Then you had the donor institution, which agreed to do the technical training, to prepay the access to the inputs, quality, etc. So you had a system in place which was reducing the risk. First of all, the right institution and policy by the central government, then the local government making sure that the local investment were taking place, and you also had the donors, but number four, you had the bargaining powers of the farmers. Because I remember that in these days they were coming together, they wanted to buy, the off-takers were saying, we want to buy the rice and we need you to produce. What do you need to do? And they were there as a group and said, we need infrastructures, we need the policies, we need the road, we need the water. If you pre-finance us, we guarantee that we give you this and this and this and contract farming. And they had to live up to the deal. And the microfinance was part of that deal that was given. So that's what I say, that when you move into a system that reduces risk, that are the things that we saw, we put in place, or we have put in place. But first of all, the farmers were organizing themselves to have a bargaining power about what they wanted. They also had to guarantee that if the finance was coming, they would actually be supplying the produce. But then the different actors were then coming together in a consultation to say everybody play their part, and that was reducing the risk. And it's a whole system that was put in place that we saw that was extremely successful in Nigeria, in Kenya, and it's a bit more refined than the traditional microfinance project. That's what I would say.
Thanks. Thanks for that. I'll let you answer, but I also want to ask a question. Maybe you can just jump into that as well. And actually, well, either of you. Oh, are you going now? Yeah. No, go ahead.
So one thing I just wanted to also add to the conversation is, rethinking distribution channels in terms of, supply of capital. So you find that, one classical DFI approach would be create a product, get the A-listed banks, push the money to the banks, and get reports on how the banks then disperse this into the sector. It's never worked, The banks create, they make it look like it worked, but we know that the money never really gets into they give it to the big corporates rather than the small Agri-SMEs that need it. And then they create transactions that make it look like they funded it. And it helps the DFI keep its AAA rating, but it definitely doesn't create the multiplier effect we want in the economy. So that needs to be rethink. On the other side, you also have the structure where you then use a PE vehicle, which theoretically should work a lot better in terms of being participatory and helping to corporate governance and building capacity of Agri-SMEs to grow. And you create a number of structures there, particularly the smaller end of the spectrum. But when you look at the DD process, almost no Agri-SME can pass through a DD process of the smallest fund, on the continent today. So then it becomes a big bottleneck. So if I look at the 4-6 months as the sole entrepreneur Agri-SME with my 2 staff and my brother, cousin working half the time, and I have to go through this 4 months full process due diligence, I might as well just go and take a 22% loan, from microfinance to finance my operations. So you have this thing where I do think that we need to rethink the distribution chain to have this capital, more accessible. And I think that may come to the point of uptake, right? People want money, you create a fund to distribute the money, and then there's no pickup on the capital. And it's like, why are you creating a new fund when the last one wasn't subscribed? I think it's that distribution model that we've created along with those capital deployment mechanisms that needs to be rethinked.
Thank you. Why don't you leave it there for, is this not working? So, turning the question actually from the demand side, and we're going to get to policy actually next. So I'll be coming back to you on that. But on the supply side, I think there were some interesting points raised, and I would love either or both of you to actually give your sense of what realistically can change, because obviously, yes, agriculture is more risky, but also I think it's true that there haven't been as much efforts as we could hope for to develop the actual means within the banking sector to address it more efficiently. Jen, you work directly on that. I think another question which was brought up is just the need to address the value chain as a whole, or sort of like more of a concerted, coordinated market approach. I guess doesn't necessarily work, but what's possible in your experience from the supply side? Where could pieces actually be moved to be more efficient? Not too much.
not too much. I mean, just all very important and all the points. So I'm trying to figure out how to answer that while, several things. I mean, IADG has made a point that I wish there was more time to debate and challenge, because if it is true that banks, where really the rubber can hit the road, are not the right or cannot be tweaked to become the right intermediary, then we have a challenge. And I would like to believe that they are. I've seen experiences. It's not going as fast as possible. And yes, I do agree that we were talking about this fintech. There is a growing direct provision of retail and SME banking that is using a different route, and the payments are still, and so we need to also consider how we can support them. But I don't think it's either or. And the banks are really a huge source of capital, and so I think we still need to figure out how to access that. So in terms of that, and in terms of supply, I think a very interesting set of conversations are coming out here around risk again. What is real risk and what is the perception of risk? And maybe if just the points that Nadine has made, and also as a question to my brother here from Marcelli. So he provided, I think Nadine, you questioned the analysis that demonstrated that agriculture was 2x, that it's more challenging. But you have also admitted that agriculture does have more risk. So inherently, maybe as the status quo, agriculture is more risky. However, because it is more risky, and because we recognize the value of agriculture for so many other important, for jobs, for a whole range of other important development impacts, we put together a whole series of policies as you have described them in Nigeria. And what does that do? That should reduce the risk. Right? And I think you've said in Nigeria it has been realized, because you talked about a bank in Nigeria that was very interested in that context of reduced risk to start delivering capital. So I would say that should mean that in that context, that risk should no longer be 2x. That you have actually reduced the risk. And my challenge, I think, and what we also, like when I was talking about our credit committee, when we sit with our teams in credit committee, we need to get better at giving them analysis that actually the risk is not 2x when we do X, Y, and Z. And maybe going back, I think IADG also had an important point in that, is I think that 2x is in the previous kind of where you're coming in the room, and the quality, the profession, the capabilities, the types of enterprise that resulted in an estimation of risk at 2x are not the types of enterprises that are coming on board. You're coming with enterprises. I guess AFEX is also one of this. When you're able to aggregate and provide market for farmers more cheaply, not only are you increasing revenue, but you're reducing risk, right? So if we need to start to be able to reanalyze with these inputs in mind, so that when we go to the credit officers, we can tell them actually the risk is much lower, and that can be satisfied, because then my brother there from Rwanda might be able to get, why should he not? It doesn't make sense that if you show that you have a warehouse and you show you have a technology to dry and store the maize, it does not make sense. But the problem is we are still at 2x risk, and we need to do the analysis and work with the banks and the capital providers so that we can allow them to reassess the risk when indeed we have put in place de-risking processes and tools.
Thanks.
Yeah, thanks. Just thanks for the opportunity to add on just 1-2 things. So I'll try again to speak or give some bit of additional clarifications on the issues that were raised or mentioned by the people in the room. I think we are all right. The only thing in my view is the scale at which we are looking at things. I am looking at a situation where agriculture is that first option that a university graduate will run to. So it is making a difference in the rural dwellers and other people, that it's probably the first or second option people run to make, a decent livelihood. We are still stuck in this situation where you have, micro farmers, smallholder farmers going to the MFI. Yes, they are helped, but does it really move the needle? Does it move them to the next level? Then on the other extreme, we have commercial farmers. They will always get money from commercial banks, private equity. That's a fact. But that's not what will change, rural economies. That is not what will get us to the next level. We are looking at a situation where we want to have the likes of, Nestle, and the other things that are more European, American, big corporates, but in the sectors that, the lady said, you can't live on coffee and other things. Why not a Nestle in rice, in maize, and these kind of things? And that's where now the real, problems they wanted to mention again are these. One, what we said is expected return, risk, return, profile and match. A commercial bank gets funding from a DFI, 100, 200 million USD, and you know what? 3/4 or half of that goes straight to government bonds. Zero risk and you get your money. Why put it in the agriculture which you don't know whether they harvest and blah blah? So that's why I'm saying they are looking at the opportunity cost of doing some things. That's number one. Number two, to my brother in Burkina Faso. It's still a puzzle that actually commercial banks could play a bigger role, but they are not because of those other options they have, but also the regulatory challenges. You need a 1 million USD. An MFI won't give you that. What we call impact lenders may give, but they are not necessarily interested in rice because it's consumed locally and this organization is international. They don't understand the realities where you are in rural Burkina Faso. Then what is the option you have? It's a commercial bank. Commercial bank may give you, you are a successful entrepreneur. By your standards, the way of, if you are borrowing $1 million from a commercial bank, I think you have reached this somewhere. But the thing is, they only give you 2 million because now the risk at their balance sheet starts to shift. It starts to look bigger, and they have capped, they can't put more in that sector because the other sectors which will give them higher returns. And the conversation we're bringing here is, if the impact is also considered in that equation, impact of agriculture, not real estate, not general trade, then we could actually start to see that your kids, when they finish school, they won't go out, they get jobs because agriculture is an option. It's really happening in Africa, in rural places, and all those opportunities. Let me stop there. But I think it's the scale. Let's look at serious agriculture. Let's look at agriculture as something that will develop our economies, not to be stuck where with the status quo where we are, and agriculture isn't making really any difference.
Thanks a lot for that, Jen. And let me use that actually as a segue to get to our last question, which is essentially on policy and trying to understand, given all of these issues, we've discussed sort of supply, we've discussed demand, what is the role of policymakers? How can it be influenced? And Nadine, if I can turn to you for this, I'd be curious to know whether there are any new opportunities to influence at the policy level, whether it's them sort of changing their minds or seeing things differently, or through advocacy and influence as a result of recent crises, and including sort of longer term ones like climate change through COVID, through some of the more recent ones, as well as some of the push that you've been working on with concerns around nutrition, health, socioeconomic development, and the environment sort of falls in there too. Are we seeing any differences? Are there any examples of how things might be changing at the policy level that can maybe unlock some of these issues that we're seeing?
You need to rephrase your question, because I heard a lot of buzzwords, but I'm yet to answer the questions you are asking.
Okay, yeah, no worries. So the question is, at the policy level, we know that there's an influence that they can have on the supply side, but also on the demand side, right? The question is, we've seen sort of policy decisions and the makeup evolve over time. With these crises, highlighting sort of the importance of agriculture, but also I think at a global level, a lot of additional push. You know, in times of crises, the world wakes up to the importance of agriculture and does more advocacy work. Where should they be pushing? What are we seeing actually work or happen as a result of these new developments?
I think I understand you. You're asking me whether we can see this crisis as an opportunity.
What are the opportunities?
That the
Exactly.
decision makers are using this crisis to maybe finally design the right policies for microfinance. I mean, I would be quite skeptical, and I would say no. I think I was sitting in a meeting this morning at Radisson Blu, and I was actually putting the point that we've been talking about access to finance for decades now. And also coming from a development organization, from an institutional financial institution, there's been money put in that for decades. There's been training of, whether it is microfinance institution, intermediary banks, now the new thing are the funds, that's the new sexy things, whether it's innovation fund, whether it's guarantee fund, whether it is venture funds, it's all about the funds now, and we've been at it for how many years? So when you're asking, are we putting in place the right policies, the right tools, the right instruments, well, at the sake of losing my job and saying that we are not delivering anything, I'm really wondering, why are we still talking about this today? We are not delivering results. And I think with the crisis, a lot of emergency tools are being put in place. You know, we need to increase production very quickly. We need to release inputs. We need to make sure that fertilizers are coming. Where are the long-term changes in the way we do business, providing finance? And Adeoji was saying, I want to have a deep conversation. We really need to find solutions. And I think when this conversation are taking place, was said there that there's a fatigue, there's a crisis. Again, we are taking quick fix, whether it's government, it's donors, and etc. And we might be sitting here again next year talking about the transformation. So I think at some point we have to say enough, and we want action. That's what I would say.
Policy-wise, I will say so.
Thank you very much. You see, sometimes we just plain vanilla is easier than all the exotic things we put around it. I like what he said somewhere. We're talking about integrated rural development. There's a disconnect. You can connect people. We did it. It was done before in Western region in Nigeria. Apologies. All those things you see around IITA, all those small plantations were integrated rural development. So the guy who is planting knows who he sells to. He knows he has a good yield. The off-takers know they pay for meat. And right there, you are leveraging schools there, and you are leveraging, ability to have access to those capital things they use. So the guy stays in business, and he knows that he has good yields, he has guaranteed pricing, and then he can leverage on insurance, education, all of these things. You see, it had worked in time past, but we work in silos and there's no coordination. And whether you're a development partner, whether it's government, we're all guilty of this. And until we begin to work, look at our people. They live in rural areas. The poor farmers are in the rural areas. I mean, young graduates, if you want to have them in agri, you have them in agri if they know that they will have access to education, lives, all of those, and coordinate them together. I think until we do an integrated rural development as we used to do in those days, that many people stay in the rural area and not bother to do about migration, we're not going to do it. And some people are doing off takers and they're adding value to it, and that's what we need to do in terms of policy. Policy is so disjointed and everybody's just doing their own. At least I can say that for where I come from, Nigeria.
And I think the question that the woman from IFAD asked, Nadine,
Sorry, can you present
about
yourself?
yes, there was a question about why we still have this. Victoria from AFDB working with Andrew, why we still have these problems, and I think on the part of DFIs as well, I think it's about measuring correctly. I didn't mention the fact that some of this money just stops at intermediaries. What are we measuring when we give this money to the intermediaries? Do we measure how many Agri-SMEs get it? What is the impact? What is not just the direct beneficiaries, indirect beneficiaries, number of households? And it's interesting I heard the fact about Nigeria because I'm from Nigeria and I never heard that story. So are we telling our stories? We're telling the stories of things that haven't worked, but this worked. Has there been a case study about it? Not just written down, a video. I would have loved to see like a 1-minute clip about that. And this is Nigeria where we still have not just this risk we're talking about. There's homeland security. We have the farmers' herdsmen that's going on. There's Boko Haram. There's elections coming up. So in the midst of this, if that can work, we're talking about the African Continental Trade Agreement. Are we stepping this up to? Let's even start from West Africa before we talk about the African region as a whole. So if there's something that has worked, what is the multiplier effect of that? Are we taking that as a case study to other places? So that's my question to you. I'd like to see if there are case studies that has been documented about that. Thank you.
Does anyone else want to chime in on policy?
Thank you. My name is Davis. I work for Agri. I wanted to add something. I don't know whether it's directly policy or it relates to something that was mentioned by one of us. I believe when we say that agri-financing is risky, it's because of the inherent systemic challenges that Africa's agriculture and farmers face. That's why we classify it as risky, whether it's the dependence on rain or not being mechanized and all that. But then the question is, the kind of financing that we design, do we include solutions for these inherent systemic problems in that financing? Because if we don't, then such kind of donor or DFI-led financing is not sustainable. The moment we pull out, then the sector will still go down again. So one of the issues could be including solutions for this. For example, how we design the financing model. If the issue that causes the high risk is about rain-fed agriculture, are we including in the financing a solution to that? Because that could at least improve the performance and the ability to repay for the farmers. So I think this is something that can be done both by the financiers, but is also a challenge to the donors and the governments at policy and at intervention level to look at those systemic risks and try to solve them in so that they can complement the financing that we are talking about. Thank you.
Thanks for that.